Are the Bitcoin gurus using a flawed formula? Many gurus, some of which are good friends of mine, are using a Bitcoin pricing model that has received an incredible amount of attention globally. Nothing makes me happier than the math guys getting attention, except, of course, when the math is wrong. The model getting the markets all hot and horny is called the stock-to-flow cross-asset model, or S2FX for short. The author, who remains anonymous, says that this model can accurately price not just assets like Bitcoin, but also things like gold and silver. If that sentence above hasn't gotten alarm bells ringing in your head yet, it should. Why do I say this? Because the stock-to-flow model is not new. Mr. Anonymous's model, as presented by Bitcoin gurus, is being talked about as if it's as compelling as Einstein's theory of relativity, which, by the way, has nothing to do with light. And with that, we can shed some light on S2FX. The truth is, the stock-to-flow ratio has already existed for decades, used as an indicator in the commodities markets. But let's first explain what stock-to-flow is first. As the name suggests, the stock-to-flow, or SF ratio, simply is the stock divided by flow, or total existing stockpiles divided by yearly production. Simply put, the SF ratio is a measure of how much of something there is to go around. Before Bitcoin came along, this ratio had already been used before for commodities like gold and silver, corn and wheat. And longtime Katusa subscribers will find the metric a familiar one. For example, after all, it's more or less the same thing as my days of supply indicator that I used when I'm analyzing commodities like copper. So again, the first thing you need to know is that the basic concept of stock to flow isn't some revolutionary new idea. It's been around for decades. However, what the author of the S2FX model does that is new is create a mathematical model that he states can, and I quote the author, enable valuation of different assets like silver, gold, and Bitcoin with one formula. Oh, really? You got my attention. We know that the SF ratio has already been around for decades, but many in the Bitcoin world think that this is a breakthrough new model that's just been developed. As Trump would say, wrong. All right, with that setup, class, let's get started. The author of this S2FX model calls it a cross-asset model. That means it doesn't just work for Bitcoin, but also, for example, gold and silver and other assets. The SF ratio had already been applied to gold and silver long before Bitcoin existed, and yet nobody came up with a similar model. So was this overlooked? Or is this a clue that something ain't quite right with the S2FX model? Another clue should be the fact that the author of the S2FX has chosen to stay anonymous. Granted, some will argue that he isn't anonymous to a select few in Bitcoin world, but why not go public? The author of S2FX is not using any inside information. There's no proprietary information and nothing offensive or illegal, so this is quite odd. Perhaps our anonymous analyst is a fan of the rock band Kiss, and figured that since Kiss got way more attention with makeup on and staying anonymous, the same would be true for his work. And just in case you were wondering, my favorite Kiss member was Ace Frehley. Ace has the best laugh in rock and roll. But back to math and back to the S2FX. If the S2FX model is as good as suggested, the potential for massive profits is staggering. So it's got my attention. When I think of revolutionary in the world of making money using math, I think of men like Edward Thorp, who you can see right here. He is a cool dude, and I highly recommend his book, A Man for All Markets. And the foreword by Nassim Nicholas Taleb, known for the Black Swan, is great also. Mr. Thorp is known as the father of card counting. A professor of mathematics who worked at MIT, he came up with various strategies to improve the odds of winning at blackjack. But Thorp didn't just talk the talk, he walked the walk. Mr. Thorp is the Elvis of math geeks. He wrote a book in 1966 called Beat the Dealer. It became a bestseller, outlining the very techniques he put to test by, you guessed it, visiting casinos and winning money in Las Vegas. So much money, in fact, that he had to wear disguises like wraparound glasses and false beards because he was getting banned from the casinos. Men like Thorp don't just come up with theories, they put their money where their mouth is, and they're not afraid to stand behind their ideas. That's the model I try to personally emulate with my publication, Katusa Resource Opportunities. I don't just talk theory, I put it into practice. I got to where I am today by following my own rules I put my name on, and as I have a lot of skin in the game on anything I recommend. One thing I can guarantee is that our anonymous analyst who published the S2FX model is no Edward Thorp or his ilk. I'll explain shortly why. Now, like I said last week, I'm no Bitcoin hater. I think it has an important role to play in our future. And all I'm trying to do with this report is bring a higher standard to the industry, just like I did with mining. There is a lot of misinformation in the world of investing, and that's true whether you're looking at Bitcoin, gold, or stocks. That's why I want to address the S2FX model to break it down to see if it has any substance behind it. So when I present the words in the blue box, that's directly taken from the author of the S2FX model. I will write comments directly after. This is in our full report. First, I will describe the concept of phase transitions because it introduces a new way of thinking about BTC, Bitcoin, and S2F. It explains why S2FX model is important. These are all the words of the author. Second, I will describe S2FX model, how it works, and what the results mean. The first part, phase transitions. Again, this is all from the author. Phase transitions are important perspective in understanding S2FX model. During phase transitions, things get totally different properties. Transitions are often discontinuous. 3 examples of phase transitions are water, US dollar, and Bitcoin. So the author now uses water. The classic example of phase transitions is water. Water exists in 4 different phases or states: solid, liquid, gas, ionized. It is all water, but water has totally different properties in each. US dollar. The phase transitions are also present in finance. For example, the US dollar is transitioned from gold coin to paperback gold in gold coin payable to the bearer on demand to paperback by nothing. This note is legal tender for all debts, public and private. Although we keep calling it dollar, the dollar has totally different properties in these 3 phases. Okay, so I may be a skeptic, but never let it be said that I don't do my due diligence. Like President Ronald Reagan said, trust but verify. So with that said, it's time to do our homework on S2FX, breaking down the S2FX model. From here on out, we're going straight to the source. So I'm going to comment on phase transitions. It's true that investments can perform in discrete increments. A junior mining company phase transitions when it acquires an exploration asset. It phase transitions again when it gets drill results, again when it establishes an initial resource estimate, again when it conducts a PEA, again when it finishes building a mine and starts producing. But you need to know that there's always outside swans that can affect these transitions to the price, such as a large newsletter writing up the stock, moves it up or moves it down. So outside items must be considered in real life situations. So the author talks about the S2FX model, BTC. Same is true for the BTC. Nick Carter and Hasu show in their 2018 study how BTC narratives changed over time. These BTC narratives seem very continuous in the chart. However, if we combine the narratives with financial milestones and later S2F and price data, they look very much like phases with more abrupt transition. So the phases were proof of concept after Bitcoin white paper, payments after USD parity, e-gold after first halving and gold parity, financial asset after second halving. So these 3 examples of phase transitions in water, US dollar, and Bitcoin offer a new perspective on BTC and S2F. It is important to not only think in terms of continuous time series, but also in phases with abrupt transitions. In developing S2FX model, I see Bitcoin in each phase as a new asset with totally different properties. A logical next step is identifying, quantifying BTC phase transitions. All right, so now I'm going to comment on what this really means. So In the mining industry, we don't call these phase transitions. They're just intermediate steps in a company or asset's life cycle. I'm going to use my good friend Lucas Lundine's mining company called Lundin Mining. He's done an incredible job, and we're thinking about you, Lucas, and we love you. So Katusa's comments on the S2FX and Bitcoin phase transitions. Now, phase transitions can explain points where the intrinsic value of an investment significantly changes. What they don't do, however, is actually lend support to or provide evidence for the author's mathematical model. You can say that phase changes causes price to go up or down, but without any math behind it, you can't say by how much. Let's take the case of Lundin Mining chart a bit further up. Each upward spike in Lundin's mining share price coincides with a major acquisition or development in the company's business. And as you can see, they even line up extremely well. If I draw a line through each of the orange points, I end up with an R2 value of 0.932, which basically means they line up fairly well. Does that mean Lundin Mining is going to keep trading along that line as long as they continue to pick up new assets? The answer, of course, is no. Not unless Lundin Mining's new assets, or what's being called phase transitions, if you will, actually add significant enough value to the company to keep driving its share price along that trend. It's theoretically simple to do this in mining, on paper at least. For a very basic calculation, you can take the discounted NPV, the net present value of a newly acquired mine, and see how it adds to that market capitalization of a mining company, less any cash or debt paid for it, of course. This, of course, is theoretical because unknown issues such as metallurgical or recovery rates or new taxes could affect the value, but you get the point. For something like Bitcoin, there's no simple way to quantify when or even if it'll see another phase, let alone how much it'll be worth. So, going back to the author's comments on this, let's dig in a bit deeper. The author of the S2FX model states, the chart below shows the monthly BTC, S2F, and price data points used in the original S2F model. One can visually identify 4 clusters. These 4 clusters that you're looking at could indeed indicate phase transitions. Quantifying these clusters can be done minimizing distance between monthly BTC data and clusters. I use a generic algorithm, minimizing absolute distance, to quantify 4 clusters. Future research could focus on different clustering algorithms, example, k-means algorithm. So then he shows the Bitcoin clusters and the 4 clusters there that are highlighted. Each of the 4 identified BTC clusters have a very different S2F market value combination that seems to be consistent with halvings and changing BTC narratives. So we've talked about those before. So like water and US dollar, these 4 BTC clusters represent 4 different assets, each with different narratives and characteristics. BTC proof of concept with S2F 1.3 and only 1 million market value is totally different asset than BTC financial asset with S2F 25 and 114 billion market value. I'm not going to argue with that, but let's get into a few comments on Bitcoin clusters. It's important to note that this section has nothing to do with actual mathematical pricing model introduced by S2FX. Rather, it simply explains when phase transitions previously occurred in the history of Bitcoin. The author groups the historical Bitcoin data points into clusters based on these phase transitions. The most important takeaway from this section is that the author uses these clusters to reduce the size of the data set from several dozen points to 4. Why is that a bad thing? Statistically, there's nothing wrong with doing so. The problem is that the author uses these 4 phase transition clusters to calculate their model. What this means is that their model doesn't actually predict where Bitcoin is going. It predicts where Bitcoin's phase transitions, and I emphasize phase transitions, are going. This might not sound like a big deal, but it exposes 2 problems. The first problem is that it makes the S2FX model a poor predicator of actual price. Now, let's create an example here using his own data. Take a look at the cluster, for example, right now. Take a look at the data points that I've circled in green, above and below that black diagonal line. These data points occur at the same SF ratio. They look pretty close together, right? Looks kind of not a big deal. Don't be fooled. That's because this chart is logarithmic. In a logarithmic chart, the axes are exponential. In other words, as you go up the chart, each point of data isn't incrementing by 1, but by a power of 10. So that means it's not going 1, 2, 3, but think 1, 10, 100, then 1,000, then 10,000. The higher of the two values is over 200 billion, the top circle. The higher of the lower two values is roughly 50 billion. That's a variance of 75% at the same SF ratio. Now imagine if I built a model and told you that it predicated a price of around $6 for a particular asset. But the price of the asset traded as high as 10 and as low as 250 when the model predicated $6. Would you call that a good model? The second problem is that by basing the S2FX model on Bitcoin's phase transitions instead of on Bitcoin's own performance, that makes the model dependent on future phase transitions. That's the key point I'm making here. According to the S2FX model, Bitcoin prices fall into clusters based on Bitcoin's phase transitions. The model predicts where these clusters go, not the prices themselves. And that's what so many of the gurus are getting wrong. In other words, that makes the S2FX model reliant on future phase transitions to drive Bitcoin prices. We'll return to this idea later. Now, back to the author of the S2FX model's comments. We're going to break this all down. What he then says is, with the phase transition perspective of BTC clusters as different assets, I can now add other assets like silver and gold to the model. This makes it a real cross-asset model. For silver and gold, I use stock and flow numbers from recent analysis by Jan Nieuwenhuis and Ultimo December 2019 prices from TradingView. So he's saying that the silver S2F is 33.3 and a market value of 561 billion, and gold S2F 58.3 and a market value of a little over 10 trillion. And he provides a chart for this. The chart shows the 4 quantified BTC clusters plus the original BTC monthly data. For context, silver and gold, they form a perfect straight line. All right, now we're going to give some Katusa comments on gold and silver in the S2FX model. All right, as you may know, I get to now play in my sandbox as I know a thing or two about gold and silver. Gold and silver have traded in a wide range these last few years. Gold, for example, has traded as high as 11 trillion in market cap and as low as 5 trillion. Its FS ratio has also changed slightly over the years. Despite this, instead of using several dozen different points of historical data like they did for Bitcoin, the author arbitrarily chose numbers from December 2019. Here's what happens when we try to apply the S2FX model to historical data instead. That's what you're looking at right now. Across the board, a bunch of green dots and blue dots. As you can see, when 115 years worth of historical data points for gold's market cap versus its SF ratio are plotted, we get an absolute scattered mess with no real correlation. Even when adjusted for inflation, any single sample SF ratio yields a range of historical market caps well over the hundreds of billions of dollars. We'll do the same thing for silver. We calculate and plot silver's historical market caps and SF ratio using the last 3 decades worth of data and compare it to the S2FX model. That's what you're looking at right now. The S2FX model does a poor job of predicting silver's historical performance. Even when using the S2FX model's own silver stockpile numbers, you end up with silver trading at 804 billion market cap at an SF ratio of 20.87 in 2010, while it also traded at a 301 billion market cap at an SF ratio of 20.57 in 2006. In between those data points, at an SF ratio of 20.72, the SFX model predicts a market capitalization rate of 91.3 billion. Simply put, the S2FX model is way off for gold and silver, which means the data points for gold and silver used by the author are not valid. They were cherry-picked to fit the model. This is very important to understand. All right, so next, the author of the S2FX model states, I use regression analysis to make the S2FX model. Note that a big difference with the original S2F model is that I use silver and gold S2F as market value data in regression analysis. S2FX model shows a significant relationship between S2F and market value of these 6 assets, low p-values f-test and low p-values coefficients, with a perfect fit, 99.7% R2. The S2FX model can be used to estimate the market value of the next BTC phase cluster. BTC S2F will be 56 between 2020 and 2024. So he gives the formula. This translates into a BTC price given 19 million BTC between 2020 and 2024 of about $288,000 per Bitcoin. All right, now let me give some math things. Now I hope Bitcoin gets to 288,000 because I'm heavily invested in a fund that does this. But let me look at the reality of the math. On gold and silver in the S2FX model, let's take a closer look at the model in question. What does it do? Market cap equals this big number times the SF ratio to the exponent. This type of equation is known as a constant elasticity function. It's well known in economics in the shape of demand curves. But as mentioned previously, remember, this model doesn't track Bitcoin prices. It tracks Bitcoin's phase transitions. According to the model, Bitcoin is going to hit 288,000 somewhere between 2020 and 2024. What phase transition does this correspond to? Where else can Bitcoin go from here now that it's already considered an uncorrelated financial asset? Well, here's the SF model through design. Furthermore, if you plot out the model, you'll see that it predicts that Bitcoin will, on average, double every year for the next 30 years. How many phase transitions is that supposed to be? How many times can we rethink Bitcoin's purpose and change how we view it as an asset? So the S2FX model. BTC, this is all from the author. BTC price forecast is significantly higher than 55,000 in the original study. Please be aware that the S2FX model is a first step that has not yet been replicated and reviewed by others. Although 6 observations is low, nevertheless, I value the results of the S2FX model relevant. I see S2FX model as a working hypothesis like S2F model. Future research could focus on adding more assets to this analysis. However, most assets have low S2F values, less than or equal to 1, and are therefore not interesting. On contrary, diamonds have a high S2F, but have a very complex valuation, rough cut, cares, different colors and brightness, man-made, etc. S2FX model allows for interpolation instead of extrapolation in the original S2F model. The original S2F model makes a forecast that falls outside the data range used in making the new model. The new S2FX model makes a forecast that falls within the data range used in deriving the formula. So we get into all this information. I'll give my comments on this now. On interpolation and extrapolation. I like this author. I really do. He can now say his model has been reviewed by others, namely me. Whether you accept or challenge my conclusions here, everyone needs to keep the responses professional and respectful on both sides of the argument. The author of the model states that his new model can make forecasts that fall within the data range used in deriving the formula. This would be important if it was true. A model that predicts future results solely based off of past performance is not a very good model. However, a model that predicts future results based on data that's already happened before tends to be stronger. In this case, however, this data that's already happened before are the data points for gold and silver. On paper, there would be nothing wrong with this if the data points were valid. The problem is that these data points were cherry-picked by the author to fit their data. As covered above, the S2FX model fails to properly track gold and silver when those historical prices are used. In other words, the S2FX model can still only predict future prices based on previous historical Bitcoin prices. The forecasts it makes fall outside the data range used in making the model. Why is this a problem? There's no mathematical justification for why Bitcoin is supposed to follow this model exactly in the future, beyond the fact that historical Bitcoin prices and SF ratios fit this model. Remember that data points for gold and silver the author added were cherry-picked to fit the model and aren't valid. That means The S2FX model's correlation is purely built on Bitcoin's past performance. Are we supposed to believe that Bitcoin prices will continue to follow the S2FX model simply because it has in the past? S2FX might give us an idea of the general direction Bitcoin prices are headed at this very moment. But as more time goes by, there's an increasing chance of it becoming less accurate and meaningful. If you've been investing for a while, you've probably seen this warning on some variation of it before. Past performance is no guarantee of future results. This is true of all investments. The story is the same when it comes to Bitcoin. So the author now, we're switching now, these are all comments from the author. Conclusion. In this article, I solidify that the basis of the current S2F model by removing time and adding other assets, silver and gold, to the model. I call this new model the BTC S2F cross asset or S2FX model. S2FX models enables valuation of different assets like silver, gold, Bitcoin with one formula. I have explained the concept of phase transitions. Phase transitions introduce a new way of thinking about BTC and S2F. It led me to the S2FX model. And the S2FX model formula has a perfect fit to the data, 99.7% R2. Solidifying known facts for the original S2F study, the S2FX model offers a new way of thinking about BTC transitioning into the fifth phase. All right, let me jump into my comments about what everyone is saying about the fifth phase. In conclusion, as we've demonstrated, the S2FX cross-asset model does not actually apply to gold and silver as advertised. The phrase phase transitions was coined by the author, and well done on that. But the concept it represents is not. Besides which, there's no guarantee that Bitcoin will see another phase transition in the future. Everyone talks about it becoming now an institutional asset. That's debatable about that being a phase transition. This model was built on 4 data points. Remember, the gold and silver data points were cherry-picked and thus not valid. Finally, recall what was mentioned about how the S2FX model is built on Bitcoin's price clusters and not Bitcoin prices themselves. Let's take a closer look at just how unreliable the S2FX model is when it comes to accurately predicting Bitcoin's performance. To pick an even more glaring example than our first one, based on historical Bitcoin data used in the S2FX model, you can see that around the SF ratio 22, Bitcoin has both traded below 10 billion while also having traded above 200 billion. In other words, the model can be off by a factor of over 20 times. People should know the reality of this such that the 288,000 Bitcoin price by 2024 that the model predicts could actually be $14,400 per Bitcoin. Let's get even a better idea of how little Bitcoin's market cap performance actually depends on its SF ratio by charting the variance of the two against each other. What you're looking at right now is the variance in Bitcoin prices versus the variance in SF ratio. So the orange is Bitcoin market cap, the blue is the SF ratio. Vertical lines on the halvings. As the chart shows, in general, the SF ratio barely moves at all, except immediately following halvings. On the other hand, Bitcoin's market cap and price, as you already know well, have been extremely volatile over its trading history. According to the S2FX model, these two variables, the lawn market cap and the lawn SF ratio, are supposed to have a linear relationship. Simply put, one goes up when the other one does, and vice versa. However, historical data going back to 2013 shows that changes in the two variables have a correlation of 0. Are you ready? 0.009. That is not good correlation. These two variables are about as unrelated as can be. When one goes up, the other one has about a 50-50 chance of going up or down. In other words, the S2FX model may provide an interesting model to explain Bitcoin's past performance, but it can't accurately predict Bitcoin's price and can't be counted on to predict Bitcoin's future results. Other problems with S2FX. I have a few other concerns with the S2FX model that I haven't been able to address yet because I've been directly responding to the author's words. I'll go over those concerns now. Let's return for a moment to the S2FX model's linchpin equation, which I'm showing you here. If you ignore all of the numbers in the equation, what it says simply is this. Market cap is related to and only to an asset's FS ratio. Recall that the SF ratio is calculated with stock divided by flow. It's a measure of scarcity, or how hard it is to get your hands on something. The author of the S2FX model quotes computer scientist and cryptocurrency pioneer Nick Szabo on what scarcity means. In his words, scarcity refers to items or assets that are, and I quote, costly due either to their original cost or the improbability of their history, and it is difficult to spoof this costliness. He calls this scarcity unforgeable costliness. Bitcoin, of course, is what this statement refers to. After all, it's extremely difficult, not impossible, but nearly so to fake Bitcoin. But what happens when the flow in stock to flow hits zero? Those of you who still remember high school math likely know the answer to this one. Well, if you use a basic calculator, you will get an error. No error is not a fancy new quantum number. But the closer we get to zero, if you divide by that number, you get infinity. Also, by the way, one of the coolest numbers in math. In other words, the SF ratio of an item that no longer being produced is infinitely large. However, if you plug this back into the S2FX model's equation, what you get is infinitely large market cap. That translates to infinite prices. Now, Bitcoin is a long time off from hitting zero flow. That's not expected to happen until around the year 2140. Ironically, the same date applies for assets like gold and silver, pre-celestial mining, of course. There are other assets we can look at to see what happens when flow goes to zero, though. And since I've talked about Edward Thorp, Einstein, Elvis, and Ace Frehley in this missive thus far, I think it's only natural I bring up the pride and joy of early 1700s Italy, Antonio Stradivari. And for all the math fans out there, the logo for integration, which you know is the integration logo, actually came about because of Gottfried Wilhelm Leibniz, who was an incredible mathematician and musician. Ironically, his original logo for integration was not the one we know and use today, but a shorthand version of the long S character. Completely independently, Stradivari perfected the sound of a violin and cut out, which looks like the integral sign used today in calculus. It was widely accepted that a Stradivarius violin made a perfect sound. Mathematicians took the cutout symbol on a violin and became the logo used for integration in calculus. Perfect calculation reference, and hence why the violin is on most calculus textbooks. Antonio Stradivari and the philosophy of supply and demand. All right. You're looking at a picture of what costs over $1 million. That's a Stradivarius violin, and you can see the integral logo. What do antique violins and Bitcoin have in common? Well, for one, they're both unforgeably costly. Famous violin maker Antonio Stradivari has been dead for centuries, and yet his instruments, known as a Stradivarius violin, are highly regarded by the musical world as the pinnacle of violin craftsmanship. Every surviving Stradivarius violin is cataloged and tracked. While the best-made modern violins struggle to break the 6-digit mark, several Stradivarius violins have been sold for millions of dollars each. They are, without a doubt, unforgeably costly. Moreover, since Mr. Stradivari is quite dead, no more of his violins can be made. In other words, the flow of a new Stradivarius violin is zero. According to the S2FX model, that would make his violins infinitely expensive. But while they're certainly pricey, they don't cost an infinite amount of money to buy. The thing is, when the supply of something rare goes to zero, that means pricing is left solely in the hands of people who want to buy that thing. In other words, the demand part of the supply, and demand dictates what the value of that thing is. I have no interest in multi-million-dollar antique violins. Personally, I prefer jamming out on a 1959 Les Paul Standard. I would wager that the majority of you have no interest in collecting violins either. But those Stradivarius violins clearly valuable to some number of people out there. Our long-dead Italian violin maker, Mr. Stradivari, certainly has no say in the pricing of his violins anymore. His inability to make new violins is not the only reason his violins are worth so much. Or else every dead violin maker would have violins worth a lot of money. Clearly, the violin buyers have some way of judging the desirability of an old violin. What the S2FX model fails to capture in this, the demand side of supply and demand. Supply ain't the only rock show in town. What you're looking at right now is the gold's market cap versus its SF ratio. So the SF ratio in the bars, gold market cap. When gold had its dramatic bull run in 2011 and 12, global stockpiles and production levels didn't suffer any dramatic changes. The price of gold did not run up to $2,000 in February of 2012 because half the world's supply of gold had suddenly disappeared, or because mines worldwide were forced to shut down. In fact, between 2010 and 2012, gold's SF ratio went down, which, according to the S2FX model, should have caused gold prices to go down, but they didn't. Instead, prices broke to all-time highs at that point, which wouldn't be seen again until just earlier this summer. It should come as no surprise, but the answer is simple. When it comes to pricing assets, supply is only half of the equation, and since the SF ratio is purely a supply-side metric, it cannot accurately price anything by itself. Finally, don't forget, Bitcoin isn't the only cryptocurrency out there with limited supply. Bitcoin Cash, Ripple, and Litecoin are also all in the same boat. Shouldn't the S2FX model apply to all these coins too? Will they all be going to infinity at the same pace as Bitcoin? Stop the flow and the stock still goes. As our good friend Mr. Stradivari has shown us, even when an asset is no longer being produced, it will still change hands. Price is a function of both supply and demand. Doubtless, if Mr. Stradivari were still alive today and cranking out violins, they wouldn't be quite as expensive as they are now. There's more to Bitcoin's price than just its SF ratio, or else it wouldn't have traded both as low as 50 billion and as high as 200 billion at the same SF ratio. In conclusion, I find the S2FX model to be inherently faulty and not mathematically sound. You're free to disagree with me or even ignore me, of course. I've laid out my reasoning, and you're welcome to pick apart my argument the same way as I've done the S2FX model. That said, I still believe that Bitcoin will have a major role to play in the future. I am not a crypto hater, far from it. Like I stated in my previous article, I have a significant amount of money invested in the crypto space myself. But right now, Bitcoin is still in overbought territory, as per our previous article. If you're a savvy investor keen on getting yourself a good deal, now is actually not the right time to jump into Bitcoin. Instead, you should remember that it's the best time of year to be on the lookout for buying opportunities on the markets. I've already got my wish list filled out. Do you? In fact, I have my year-end wish list, and it's available now for all Katusa subscribers on our website. Please stay safe and stay well during these difficult times.